The United States created so much new money in just a few years that, by historical standards, this should have triggered a currency crisis rather than an economic recovery. In almost every other country, actions on this scale have ended with runaway inflation, collapsing savings, and long-term damage to everyday life. For example, France would say this: "We cannot do this. This economy, it is dead." That reaction may sound dramatic, but historically, it's not exaggerated. When countries without massive global influence attempt this, confidence in the currency disappears quickly, prices surge, and economic stability unravels almost overnight. And yet, the United States did it. No collapse, no emergency reset, no immediate disaster. Which isn't reassuring. It's suspicious. And here's why this matters to you. Because this decision doesn't stay inside government offices or financial charts. It shows up in your rent, your grocery bill, your savings account, your investments, and that growing sense that even when the economy is described as strong, everyday life feels more expensive. You're not imagining that. According to basic economics, what the US just did should not have worked. So either the rules changed, or the bill simply hasn't arrived yet. To understand what's really happening, we need to clear up one massive misunderstanding first. When people hear the phrase printing money, they tend to imagine governments physically creating piles of cash. But that's not how modern money actually works. Today, most money isn't paper, it isn't coins, and it isn't stored in vaults. Most money is digital, created inside the financial system itself. Think of it like a massive online scoreboard. No one prints new bills. No one delivers bags of cash. The number simply increases, and everyone agrees that those numbers represent real purchasing power. And those numbers determine where people live, what they can afford, and how secure they feel financially. So how does new money actually get created? It happens in three main ways. First, banks create money when they issue loans. Imagine you go to a bank to get a mortgage. The bank doesn't grab money from a vault, it simply adds numbers to your account, and just like that, new money exists. You get a house, the bank gets a promise, and the money supply quietly gets bigger. Second, governments create money when they borrow. When governments spend more than they collect in taxes, they issue debt, and that money flows into salaries, benefits, contracts, and projects. Again, the total amount of money in the system increases. And third, central banks step in directly. When the economy slows down or starts breaking, central banks buy financial assets and inject money into the system to keep everything moving. Think of it like pouring oil into an engine that's starting to seize. The goal isn't to make the engine faster, it's to stop it from breaking completely. Now here's the part that sounds good, and also dangerous. When the economy slows, people stop spending, businesses stop hiring, and layoffs start piling up. So creating money can prevent a bad situation from turning into a disaster. And in the short term, this often works, which is exactly why governments keep doing it. But creating money doesn't create real things. It doesn't build houses by itself. It doesn't grow food, and it doesn't magically produce more services. Imagine a concert. The stage stays the same size, the band stays the same, but suddenly there are way more tickets. Everyone still gets in, but nobody is comfortable. More tickets chasing the same concert is inflation. More money chasing the same real stuff. Historically, this is where economies start running into serious trouble. So why didn't this explode immediately in the United States? Because the US dollar plays by different rules. The dollar isn't just America's money, it's the world's money. Global trade runs on dollars, oil is priced in dollars, international loans are paid back in dollars, and central banks all over the world hold dollars as reserves. Right, terribly sorry, but we'll need some dollars for this. Because of this, when the US creates new money, a large portion of it doesn't stay inside the country. It spreads across the world into trade, foreign banks, investments, and central bank reserves. Imagine filling a bathtub, except half the water immediately flows into bathtubs next door. The water level rises more slowly, but the water still exists. This global demand helps delay visible inflation at home. Delayed, not erased. Now let's talk about where that money actually went. A lot of it didn't go into wages or everyday spending. It went into assets, stocks, housing, and financial markets, which is why charts looked amazing while affordability quietly disappeared. Home prices rose faster than incomes, investments grew faster than savings, and people who already owned assets pulled further ahead. Meanwhile, everyone else felt like the system was stable, but unreachable. Another reason inflation didn't hit immediately is something called the velocity of money. That's just a fancy way of asking how fast money moves from person to person. After big economic shocks, people spend less, save more, and wait. Everyone suddenly becomes very responsible. Even with more money in the system, slower movement means prices don't jump all at once. But slow effects are still effects. This leads to the most dangerous misunderstanding of all. If the US can do this, why can't everyone? Because most countries don't have what the US has. They don't have global trust, reserve currency status, or endless demand. We tried, it did not go well. When weaker countries print money, prices explode, currencies collapse, and confidence disappears almost immediately. Which brings us to the real risk. Money only works because people believe it will still have value tomorrow. Confidence is the invisible glue holding the entire system together. Once that belief weakens, things can fall apart very fast. And now, those delayed effects are starting to show. Prices are higher, borrowing is more expensive, and the cost of years of easy money is becoming harder to ignore. The bill didn't disappear, it just showed up late. So why does the US keep doing this? Because for now, the system still holds. But history is very clear. No monetary system lasts forever. And when money grows faster than trust, adjustments always come. If this helped you understand why life feels more expensive even when the economy looks strong, subscribe for more clear explanations of how the system actually affects you. Because this isn't just about economics, it's about how the future feels.